All right. Thank you for joining me today for this presentation. So we're going to begin by the questions that you have for me.
Yeah, so I guess honestly, I do know a fair, I would say a fair amount when it comes to ETFs. My
Mhm.
main thing is how do you know what the ETF consists of? Like I know certain ETFs, it's technology based, or this
Mhm.
ETF belongs in this category, or this ETF belongs to that. Like, how do you know what is what? Like, which companies belong in that ETF is what I'm asking.
Okay. So in the presentation, I'm going to show you a website, but essentially, even if you just Google it, it'll give you the breakdown, so you can say what companies belong to this ETF, and it will give you the breakdown. I'm going to show you a website that you can use
Mhm,
that lets you know what the top holdings are in a specific ETF, so then you
mhm,
can understand what it is that you're investing in.
mhm.
Any other questions?
Right. Yeah.
That's the only one?
Uh, that's honestly my main one. Like for the most part, I know what an ETF is,
Yeah.
right? And guess like what is your strategy on
Hmm.
ETFs? I guess like for long term, right? Because
Hmm.
that's what I'm thinking of. Like I'm more so investing for retirement right now, so I'm thinking 65,
Hmm.
right? So like, what is the best like strategy for that?
You are how old?
I'm 38, 39 in October,
Okay. What day?
14, October 14.
Oh, okay. My daughter's the fifth.
Oh,
Yeah, so hopefully, so that question, it can be answered in a short way, but this whole presentation should give you a clear understanding of what
mhm.
to do and the strategy that I use that you can start using as well.
Okay.
Okay. So after this presentation, if you have, feel free to stop me anytime if you have questions.
Sure.
It's only us right now, so it doesn't even matter, you know? Anything that's unclear, let me know so that I can explain it again. Don't feel like you have to, like, there's any stupid question. It's
Mhm.
open floor. I'll answer anything to the best of my abilities. And then at the end, after it's all said and done, I'll present you with my offer, and if you want to move forward, then we go from there.
Sure. Yeah.
All right. Okay, so I'm gonna just open up my thing here. I tried doing this in a particular way last time, but everyone said they couldn't see it. And I was like, why didn't you tell me? They're like, oh, I don't know. Hopefully I have pen and paper. You can see my thing.
Yeah.
Perfect.
Well, it's blank. I just see a blank. Well, yeah, I see it now. Yeah, I see it now. Think like an investor.
You can see it, but I can't. Interesting. What's going on with my thing? Okay, there we go. If I'm cutting out, let me know.
Yeah, for
All
sure.
right. All right. So think like an investor. Make clear stock decisions without guessing. Build wealth with ownership. Swing trades for cash flow. Leaps to scale opportunity. Leave with the system, not random information. So tonight is clarity over confusion. And one thing that I have been learning about not just only myself, but others, everybody wants to pick the right stock, but I don't think that's the right question that they're asking. It's who am I becoming that's going to choose the stock that best suits my needs. And if
Mm,
people started to figure that out, life would be game changing for them because there's it's like it's not hard to find the right stocks, but everybody just wants the clear winners that they're seeing on social media or the news is saying this company's hit all-time highs or this is going to be the next biggest thing. But you don't need all that hype. You just got to find the companies that are making money and stick with those companies. And that's what we're
mm,
going to go through today. So quick disclaimer, this is educational only, not personal financial advice, not legal or tax advice. Do your own research. Speak with a licensed professional when needed. So tonight has one goal, give you a simple investing system that you can actually use. Know what to buy, when to enter, know which strategy fits, and know when to walk away. If you leave with clarity today, that's a win. You're going to do some work. So this is not just something where you sit back and just watch me talk. You will answer questions, you will test your stock ideas, you'll build a decision process, and you will leave with the next steps. So first we're going to start with a little quiz, true or false. You need to be a genius to make money on the stock market.
No, that's false.
Very good. So stocks are not an IQ game, they're a system game. And when you can understand that, everything changes for you. Smart people lose with no system. Average people win with rules. It's like I heard something. It went people say they want freedom, but in
Mhm.
order to have freedom, you need to have boundaries. And a perfect example is when you buy a home, that's yours. That's your boundary. Nobody can come inside your home and violate your space. That's freedom. Your that roof over your head, that's your freedom. And people, they say they want freedom, but they have no rules. And if you don't have rules, how do you have something to contain that place of freedom for you, right? So when
Okay.
you can understand that, stocks, it's a whole different thing when you start looking at the stock market. So true or false? More tools automatically make you a better investor.
Oh yeah, that's true.
False. More
False.
more tools often create more confusion. So you don't need 20 indicators. You need simple rules that you can repeat. Yo, I don't know if you watch stuff on like YouTube or like Instagram. People will be like, I use this indicator, that indicator. But it's like, do you watch Simpsons?
Not really, no, but used to. Sure.
Okay, perfect. Okay. Do you remember when Homer found out he had a brother?
Sure, yeah.
And then his brother's like, I want you to design a car.
Yes, yes, yes. I
And then
remember that.
Homer put everything possible in it.
Yeah, yeah. I messed it up. Yeah,
Exactly. And he's like, I'm ruined. My company's a thing, right?
yeah.
That's literally what happens to people, but they either freeze, get analysis paralysis, or it's like the indicators that they have are not complementing each other. They're going against each other. So a lot of people think like I need this, I need that. It's like, no, you don't need that many things. Like everything in life is comes down to simplicity. Just us
Mhm.
as humans, we think everything needs to be more difficult. Like another example, the Tesla. His cars are super basic. Every other car has all these buttons and gadgets. The man just came with a screen and a steering wheel, and that's it. And he's one of the top auto producers.
Mm. So just keep it simple. Okay.
Yep. Most beginners lose because they picked the wrong stock. True or false?
I think that's true. Yeah.
Mostly false. So the
Mm.
bigger issue is no plan, no entry, no exit, no risk rule, no patience. When you don't, again, no boundaries, everything just falls apart for you. A lot of people, when they get into an investment, they invest with emotion. Stocks, any type of investment, even in business, you can't have emotions. Like the game doesn't have emotions, and you can't bring your emotions into it because your emotions will ruin you more than the stock market will.
Mm. Okay.
True or false? One stock can be a buy, hold, swing, leap, or a pass. You may not know these terms, but you will at the end of this.
True.
Yes, a stock is not the full decision. The strategy matters, time horizon matters, risk matters. That's where the real strategy lies. True or false? The longer you hold a quality asset, the more the math favors you.
False.
True.
True.
Days are
Okay.
noisy, months are emotional, years reward ownership, decades reward discipline. Day traders, the majority of people that day trade lose money. Nobody would ever admit it. The ones that you see online saying day trading,
Yeah.
it's far few in between that are actually making money day trading. Not many people are make money day trading. Maybe 1 out of 100, I say, are making money. They make money, but then they lose it after.
Mhm.
The longer you can hold onto a stock, the more money you'll make. And if you just look at the chart history, you'll always see that the longer somebody has waited, the more money they have made. I don't know if it's your algorithm, but on mine, they'll show you if you bought this stock last year, you made this much money. That's only a year. But if you bought it when it started, you would have made a significant amount of return. Like example, like Apple. I think it's like some it's 1,000 or like 10,000% return if you bought it back in like 1980s. Most people want to buy a stock today and sell it tomorrow and make $1 million. But
No, that's
you gotta play the long game. So the longer you can hold on to a stock, the more likelihood the stock price will rise and go in your favor. When I started investing, I remember seeing Apple for $100 and I didn't buy it. I seen it go up to $200, then about $400, and then I seen it crash, and then I was like, "Oh, I've never seen something like that happen." It went from 400 to 200 in like a matter of seconds, but
wow.
then it went back up. I didn't buy because I didn't understand how these moves. Because
Mhm.
when you're watching a stock daily, there's a lot of noise happening. Like think of it like the 401, um, 7:30 in the morning, or not
Mhm.
even that. The DVP, just pure traffic, just a whole bunch of congestion. But if you drive the 401 at like 3 in the morning on a Tuesday, it's going to be very empty. So, and plus, if you're going like say out of town, there's going to be a clear road, right? And that's how you kind of want to look at your path of investing. So you said you want to go for retirement.
Mhm.
That's about 25, 26, 7-ish years, which is
Yeah.
more than enough time for you to start investing and grow something. So if I deliver today, is it okay if I show you some or not some of you, but show you how we can work closer with me? No pressure, no tricks. And yeah, so is that okay?
Yeah.
Okay. Mind you, this is a presentation that was built for a lot of people, but we're just doing the one-on-one thing.
Mhm.
So the real problem is not stocks. The real problem is the decision chaos. You see a stock move, you get excited. You buy too late, then fear makes you sell wrong. I've had this happen to me thousands of times where I'm like, damn it, the stock is going down and I want to go up. But if you're
Mhm.
looking for those short-term moves, it will always go against you the moment you buy into it. But if you're looking to buy and hold till you're retiring, there that the daily stuff shouldn't even bother you. It's just they're like blips in the chart. That's it. Inflation is eating, sorry, inflation is the safe plan. Inflation is eating the safe plan. So money still is not really standing still.
Mhm.
Bills go up, food goes up, rent goes up, savings quietly loses power. And I think everybody feels this when they put money into their savings account and they see a penny or like 2 cents and you're like, what the hell is this? Like,
Mhm.
my money's not making nothing. And I kid you not, I went down to Fan Festival last week.
Right.
Guess how much a beef patty was?
Probably like $10.
$7.
Yeah. Yeah. Yeah.
So the price of a patty went from $1 to $7. And I can guarantee your savings account has not made more than $10 in that time
In the
span
year.
of
Yeah.
it growing. So it's like you put money into these savings, but who is it really benefiting? You or the banks? So you got to really take a closer look at what your money's really doing for you.
Mhm.
So imagine owning a money printer, but refusing to learn how to protect it. Would you insure it? That's a question for you.
Mm.
So you had a money machine.
If I have a money machine and I have to protect it, yes, I would insure it.
Would you maintain it?
Yes, I would.
Would you track it?
Yes, I would.
Your income deserves the same type of system. A portfolio without a process is an uninsured money printer.
Mm.
So investing without a system is like driving at night with no headlights. So as you can see, this guy's driving, or
Mhm.
both guys are driving with no headlights on. So you might move fast, but you cannot see the danger. The road is the market, the headlights are your rules, the brakes are your stop loss, and the GPS is your plan.
Mhm.
So what the questions do you have so far?
So one question that I have is the emotional aspect of
Mhm.
investing. When to actually when to sell a stock. Well, in this instance, I'm talking ETFs is I know it's long term, but
Mhm,
just general, like if I was to buy and sell, when is the right time to sell the stock? Right? Because some days you're gonna see it go up, go up, go up, and then it's so volatile. Like the next day it could just drop,
mhm.
right? So when is the best time to say, you know what, let me sell now, as opposed to holding and losing out?
Okay, so this can you see me or you just see the
Yeah,
screen?
no, I
You
can see
can
it.
see me?
Yeah.
Okay, so this is you buying a stock today,
Hmm.
and then this is tomorrow, and you're watching all the noise happen.
Yeah.
When your time horizon is longer, you won't even notice that little blip that's moving the stock
Mm.
because you're buying a quality company. Second thing is
Nice.
you should the rule of thumb is you buy and hold forever when you're investing. Because
Okay.
if you buy and hold forever, two things happen. Appreciation happens with the stock, just so long as it's a quality company.
Mm.
Second thing is, if you don't sell it, you pay no capital gains. So you have
Yeah,
an asset.
that's true because when you make, yeah, that's true.
But if you do have to sell, the best reason or the reason that you should have is the story change behind the business. So once you create a story or know the story as to why you bought it, when that story changes, that's your reason to sell it. So for example, Apple says they're going to go into designer clothes and stop making iPhones. Do you think that would be a smart decision for them to do?
No.
That their story just changed. So now
Mhm.
you say, screw that, I'm selling, I'm moving on to something else. Make
So
sense?
no, it does. So
Mhm.
should I kind of, I want to say it's a direct comparison, but should I look at it as looking at property in a sense? Like looking at a quality company, kind of like property, meaning that it's gonna always appreciate, but it's gonna have its ups and downs at the
Just
same
so
time.
long as it's a quality company.
Yes,
We're going to
exactly.
go through it. Yes, so I'm going to give you the criteria for a quality company. So the
Okay.
same way you do your research before buying a home is the same
Hmm.
type of research you would be doing before you buy a stock. And most people they skip doing their homework for stocks, but won't skip their homework for buying a home.
That's right. That's right. Okay.
Both, even though it's not a large amount of money, over time it can add up to that large amount. But
Hmm.
if you don't discipline yourself and say, "Hey, let me go take some time and do some research on this," then it doesn't happen for you. Was anything unclear?
No, no. Okay.
I got to type it there. I got to fix that. Anywho, so I know what it feels like to work hard and still feel behind. So like this guy, always tired at the desk. By 11 o'clock, I'm falling asleep. No, by 10:30, I'm falling asleep at the desk. So I
So
worked
that,
long hours, multiple jobs, traded time for money. I thought more work would create freedom, but tired did not equal wealthy. Hard work without ownership has a ceiling. So I thought the answer was make more money. Then I learned making money and keeping money are two different skills.
mhm.
You can make money and still feel trapped. You can invest money and still lose without rules. You can know information and still not execute. And I think this is the majority of people. They have the information and they don't pull the trigger. Everybody says, I want to make money, but then they're afraid to even put a dollar into the market. So I have won and lost in the market, and that's why I do not teach theory. I've made money from process. I've also lost money when I broke rules. The lesson was clear. Rules beat emotions. When you have rules, yeah, sometimes you do feel like, oh, it's down a bit, but it also protects you because one thing a lot of people do, not so much with investments, but with trading, they don't trade with stop losses. And when you don't trade with stop losses, it's like it goes down. You're like, okay, I'm gonna wait for it to come back up, and then it never comes back up. And it's like, okay, when it gets to this point, I'm gonna sell, and then it gets there. It's like you have these rules in place so that you don't allow your feelings to get involved and then start making the decisions for you, because it will just completely ruin you. Like this guy in the red picture here. So I built a six-figure portfolio, then life exposed my weaknesses. A portfolio without a foundation can still get shaken. A strong with no strong emergency fund, debt pressure, life happened. The lesson, investing and money management must work together.
Mhm.
And that's when the lesson hit me. Investing is not just picking stocks. Investing is money management, risk management, emotional management, and having a system. Stocks are not an intelligent game, it's a systems game. And once you have your system in place, everything works beautifully. Then I started seeing the market differently, not as a casino, as an ownership system. Great companies have customers, a system, and profits, and you can buy into them. That is the hack that or cheat code to life. Most people are like completely missing out.
Mhm.
People say, I want to start a business, so I'm going to start a side hustle. Why don't you just put money into the market and let them do the work for you? For example, how many of your friends have an iPhone?
No, pretty much all of them.
So why not just buy into Apple?
Yeah, yeah.
You sit back, you collect the check. How many of your friends? Okay, so when you're at that party, how many of your friends or people you seen at the party drinking alcohol with a soft drink?
Everyone. So why not invest into Coke? That's what you're saying.
Exactly. Like
Yeah.
these are things that we consume or use on a day-to-day basis. Like right now, I'm using Zoom. That's a publicly traded company. I'm on a
Mhm.
MacBook, publicly traded company. Like all these tools or these things that we have at our fingertips, it's like, why
Mhm.
are we not just utilizing these and capitalizing on them? Apple's been mo making money since early 2000s. From when Steve Jobs said 1,000 songs in your pocket. The man changed the game.
That's a wrap. That's a wrap. Yeah.
That's all the man said. 1,000 songs in your
Yeah.
pocket. Yo, the man crushed us. Like us having CDs, it's like, what do I need your CD for? I have an iPod now. Like, you know?
Series was done. Yep. Yep.
So
Yeah.
that's the way you start thinking. You start thinking, if I got some cash, why not just invest in this business and start getting a return from it?
Yeah.
On top of that, I can make more money by putting into a company versus putting it into the bank that pays me less than nothing.
That's right. Yeah.
So I found a system used by great investors. Then I adopted it for everyday people. So to find quality companies, wait for better prices, choose the right strategy, risk management before emotions show up. So this system has produced real wins, including a $35,000 trade and student wins. So this is one of my previous trades where I made $35,000.
Mhm.
The win came from a process, not random guessing, not hype, not needing to be a genius. You can be the dumbest person in the world. If you just follow the system, you will make money. But if you're somebody that wants to be, you know, one problem I have with, and I find this to be with Canadians, I could be
Yeah.
wrong. We have too much of an ego problem. And
Mhm.
nobody wants to humble themselves and be like, you know what, let me learn from somebody else that knows more than me. That's a cheat code to life. And if you can understand that, you will get so far ahead in life. But everybody wants to be the smartest person in the room. If you're the smartest person in the room, you're not making shit.
You have,
You're literally you capped yourself. You're at a
yeah.
ceiling. You got to get into a room with other people that are making twice as much as you are, 10x more than you, because that's how you learn and you grow. When you're like, it's like we're in this little pot and we don't want to go to the garden. It's like,
Mhm.
make it make sense to me.
No, very true, man. It's very true.
But the biggest win was not one trade. The biggest win is becoming someone who follows a plan. No panic plan, no revenge plan, no guessing plan, a rule based plan. Have you ever traded or do you trade?
Yeah, I've traded before. Yeah.
Okay. So one thing is you gotta unlearn to relearn. And when
Mhm.
you can unlearn what you have previously done and do something that's different and it works, you stick with it. You don't change it because you feel that it's boring or it's like, oh, maybe this will work this time. It's like, no, if it works, let me just continue with it. All right. So, based on that part, what
Mhm.
questions do you have? And was anything unclear?
No, that was clear. That's good. That's good. Yeah.
All right. So most people live in the today box. So everybody's in this little box. So just how I said, like the plant, this is how everyone lives.
Mhm.
They only make a decision based on what hurts right now. Today's bills, today's fears, today's pressures, today's desire to feel safe. If you don't plan for tomorrow today, tomorrow looks exactly like today. Same
Hmm.
stress, same bills, same money habits, same lack of ownership. Do you remember that movie Groundhog Day with Jack?
Yes.
That's what everyone's living, especially Canadians.
Hmm.
Broke people or broke thinking ask, how much interest will the bank give me? You know the bank's not giving you more than 4% if you're lucky, and it's gonna be for 3 months only.
That's right. Yep.
Where's my money safest? How can I avoid risk? Can someone else decide for me? That is like the thing that I absolutely hate the most. It's like people come to me, what stocks do I buy? I can't tell you what to buy because you know why? You're taking the ownership off of yourself to put it onto me. Because
Yep.
now, if I make a wrong decision, you now have a finger to point to somebody instead of
Yep.
blaming yourself.
That's
You
right.
click the button. I didn't click it for you. You came to me because you didn't know what to choose. But
Mhm.
if you have a system and you follow the rules, you will be able to find companies. And I'll prove that to you today. Wealthy thinking ask, how much of this bank can I own? What asset can I buy? What can grow for decades? What can pay me while I sleep? So let me ask you a question. Who do you bank with?
I bank with CIBC and TD.
Okay. Do you know both of those are publicly traded?
Yes, I do know that.
Okay. And are you aware that TD hit an all-time high maybe a week or two ago or
Not
within the last month?
no, no, I do
Okay.
not know.
So now I'm going to tell you something else that's going to shock you. Let's see here. TD.TO. All right. Oh, that's not it. TD stock price. Oh, it's actually just TD. Okay. So let's see here. Okay. If you put in $100 at
Hmm.
the beginning of the year, you would be up 31% right now. You would have made
Seriously?
$31. Yeah. And
No, you're joking right now.
oh, it gets better. Let's say you put money in 5 years ago.
Uh-huh.
Your money would have doubled.
Oh shit.
And that's not including dividends.
Hmm.
Now, what does your bank pay you on a monthly? What does your bank pay you on a monthly?
Oh, pennies.
Pennies.
Yeah,
So
pennies.
if you put on $100 at the beginning of this year, you
Hmm.
would already be up 30%. If you put $100 in your bank account, you wouldn't even hit 1% yet.
Yeah, no, 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 no.
So
No.
right there, I just gave you one, invest where you put your money. Instead of putting your money in the bank, put your money to own the bank.
In the bank.
So now,
Mm.
if you're saving for retirement, why not just buy TED and just sit and hold on it? CIBC, I think, has gone down, but they were on my list of companies. The one good thing about Canada, we only have six major banks,
Yeah.
opposed to like the States, because they got like 50,000. So
Hmm.
six major banks. You can go route A or route B. Own the individual stock or own the ETF with all those stocks.
Mm.
So now you own the banking of Canada. Royal Bank has hit how many all-time highs since like the beginning of the year, and they're like $290. So now I hope that just opened a
Mm.
door for you to be like, why am I putting my money here if I could put my money there? Remember,
Yes.
what every dollar you put in the bank, you're allowing that bank to lend out $10.
Yeah. Hmm. Okay.
So if they're lending that money out and charging interest rates anywhere from 8 to 22%, why not flip it and now become the owner of the bank, and now you're the recipient getting that money because when they show earnings, guess who gets that money?
I'm
You
getting
do.
that. Yeah. Yeah.
So earnings comes up, boom, dividends pays out, they're paying you out 4 times a year. So you're making dividends on top of the price. Yes, the price can go up and down, but remember when I told you 5 years you would have doubled your money.
Yeah.
So if you
Yeah.
just kept putting in that right there, 10
Yep.
already turned into 20 by year five. Whereas you're saving, you're busting your ass, you're putting your money in 10 grand in 5 years is only 10,100. Make it
Hmm.
make sense. It doesn't.
Man, I wish I knew this earlier, man. Wish I knew all this stuff earlier.
Listen, you know it now. So that's a good thing. You're here now. That's all that matters. All right. All right. The top wealth builders own companies. They do not need to create the company to benefit from ownership. Hey, if you have a solid idea, be my guest. You can buy shares, you can receive dividends, you can benefit from growth, and you can build ownership over time. So I'm gonna teach you a life hack now.
Yeah.
So remember when I told you you want to buy and hold forever, right?
Yeah.
Wealthy people don't sell their shares.
Hmm.
They borrow against their shares.
Just about to ask you that. Don't they borrow against it? I was just about to ask you that. Yeah. Yeah, yeah. Okay.
Two reasons. It's cheaper
Hmm.
and they avoid paying taxes.
Yeah. So wait, it is tax free when you borrow against your stocks.
Exactly. You
Okay.
pay interest, but the interest will be cheaper than you paying taxes on what you make because the
Yeah.
moment you
I know,
trigger it,
right.
if it's not a TFSA, you trigger capital gains.
Hmm.
You trigger capital gains. 50% of what you made is included in your income.
Okay.
So if you're in, let's say you're in the third tax bracket,
Yeah.
and that 50 takes you to the fourth tax bracket, that's getting taxed at that fourth bracket now. So
Okay.
whatever that interest or that tax is, that's what's getting taxed. So you can be getting, you make 50 and it gets you to the next bracket, and then you end up paying like 15,000 in taxes.
Yeah. Yeah.
Whereas if you borrow against it, you're paying 8, 9%. You're probably paying a couple thousand bucks
Yeah. Sweet. Yeah. So
interest.
everybody can borrow against it at that point for sure.
That's how you play the game. So right now, um, I have no affiliation with them, but Wealth Simple allows, so you're familiar with line of credit, right?
Yeah.
So with a house, they call it a HELOC, so home equity line of credit. Now they have PLOC, which is portfolio line of credit. So
Hmm.
if let's say you had 100,000 in there, Wealthsimple will allow you to borrow 60% of that.
Okay.
So you have that portfolio. Now the smart man does is you take that money out, but you put that into a new vehicle. You put that into real estate. Now that real estate's cash flowing for you, and it's also depreciating at the same time. So it's cash flowing, it pays down the debt, debt's paid off. Now you have a house that's cash flow, that's more it's more of a safer investment while you still have the stock. So now you have two for the price of one. And that's how you start building your wealth.
Okay. Hmm.
All right. So that was life hack. Bless you.
Thanks.
So hard work creates income. Ownership creates wealth. Income pays bills. Assets buy back your time. Wealth creates options. Options create freedom. Income turns into wealth. Wealth turns into freedom. That's what I want you to remember, okay? So rich people measure success in things. Wealthy people measure success in time. More control, more choices, more family time, more peace. You have a daughter, right?
No, I don't have. I had a daughter. I don't have no kids.
Oh, my
Yeah.
condolences. All
Thank
right.
you. Thank
Yeah. So, there's nothing. What happened? Okay, there we go. You're not trying to be perfect. You're trying to become consistent. Not the perfect stocks, not the perfect entry, not the perfect amount, a repeatable process. So going back to this, there's a difference between rich and wealthy. When people say, "Oh, do you want to be rich?" I tell them no. I say I want to be wealthy because wealthy people measure success in time. They don't care about the dollar figure. Like wealth to you can mean something totally different to me. When people measure rich, it's having a lot of money, being able to do this. But rich people can also be stuck to a job or married to their job, like
you.
lawyers or accountants or even doctors. Their money or their income depends on them having to work. Yes, they make a lot of money, but they got to put in the time to make that money. Whereas
Yeah.
a wealthy person, their money's making money and they get to enjoy their time how they see fit. Wealth could mean you paying off your house, you not having to work, your bills are covered every month, you're good. That could mean probably house paid off and maybe 200,000 in the account and it just pays you monthly. That's what wealth could look like for you, right? Wealth is different for everybody. So it all depends on how you picture what your life looks like and what you want to be doing when you retire. Like for me, I kind of like gave Chat GPT like I handed Chat GPT its ass because I was like trying to create something. I was like, it finally came out to me because I was getting so frustrated what I really want my life to look like. And when you
Hmm.
can design what your life looks like, then you can start working towards that type of life that you want. A lot of
Sure.
people think that the goal is the to reach the goal, but it's actually the journey to reach that goal is what you should be enjoying. Because once you hit that goal, you're gonna ask yourself, now what?
That's true. Yeah. Right.
It's enjoy the journey up until that goal. And once you hit that, now you figure out what's the next goal to achieve. So you're not trying to be perfect. Okay, I said that already. The market rewards time. The longer you hold quality assets, the more the odds improve. So this is what we were talking about earlier. And look at this here.
Hmm.
53% of the days may be up. Okay.
Hmm.
So that's days. If you're looking at it a day, maybe 53% of the time will go up. But your odds get better the longer you hold. 62% of the months may be up. 74% of the years may be up. 94% of decades may be up. Go look at Microsoft since the 80s,
Yeah.
and you just see it go whoop up. Go look at what's that next company? Apple, whoop up. Google, whoop up.
Mm.
All up like this, but that's all in the decades. Any if you go to end the majority of charts from like when they started to where they are now, you're gonna see a lot of up for the quality companies. If you pick something like what's another company? I don't want to say a technology company. There's a next one. Walmart.
Right.
Whoop up. Oh, what? Expect stronger quality margins. Damn, I missed this one today. Ooh, 17%. Oh well. All right. So the longer you're holding, the more it goes into your favorites. So if you had to choose days, months, years, or decades, which one would you choose?
I would choose decades
Why?
because I feel like the longer the company is there, like the more profitable it is.
There's
In the
only a 6% chance that it's going to go down.
mm,
The odds are in your favor right there. Like if you're betting to play, let's say Bronny James is 53% going to be the person that scores the high of the game, and there's a 94% chance is LeBron is. You're betting on LeBron all day long. So why not just leave your money and let it sit there for decades?
yeah.
This is how people need to start thinking. When they can
Mhm.
get their head around that, it's a game changer for them. The market drops are normal. So that is one thing a lot of people don't like to see. But what stock market continuously goes up and up? None.
Mhm.
Everything has to come down sometime, right? So you got to stop looking at the market like, oh, it's red today. Oh, it was red last week. It's like that's just short term noise. Like you that will go over, like,
Mhm.
So they are not always dangerous. Sometimes they are opportunities. 5% drops happen often. So maybe once every month there may be a 5% drop.
Mhm.
10% drops happen regularly, so maybe once every couple of times for the year. Then 20% drops happen every few years. Quality companies can go on sale. For example, Meta, and just don't mind me about the tech heavy companies because that's what I fairly watch. But
Mhm.
Meta, Netflix, Microsoft, all have dropped below 20%. All are quality companies.
Yeah.
If something, okay, picture these companies as like Jordan releases back in the early 2000s.
Mhm.
You already know you're spending a 250 on the shoes, right?
Yeah.
But Foot Locker says this one day only, we're going to be selling this for like 50% off. You know,
Oof.
the whole of the GTA is going to be in front of Foot Locker.
That's right.
When it comes to the stock market, everybody runs and says, oh, I'm not touching that with a 10-foot pole. It's like, why? If the company is telling you they're making money, year over year. Why wouldn't you buy it if it's less than it's 20, 30% off?
Hmm.
That's like that's like Black Friday only coming on once every 2, 3 years. If
Hmm.
Black Friday was like that, people, I think there would be 10 times more sales because we were like, damn, it's going to be a very long time before I can get this sale again, right?
Right.
And that's how you got to start looking at the stock market. So, did I just show you why investing is more than just stock picking?
Yes. Yeah.
So, it's identity, ownership, it's time, it's a system. So, what questions do you have, and was there anything that I wasn't clear about?
It was very clear. What I'm realizing that it's really a mental thing and like how you kind of navigate it through everything, right? Is I'm noticing, yeah, like even what you just said when a stock is on sale,
Mhm.
right? I've noticed a lot of rich people end up buying more when it's like
Exactly.
that, and the poor mindset is more so to run away, right?
Yes.
So yeah, I get it. I get what,
You just buy, you buy more and more. You
yeah.
see, especially with black people, our problem is we see something on sale, we buy more of that. Like
Mhm.
laundry detergent goes on sale, and we act like laundry detergent's scarce, like it's never coming back. But
Yeah,
we want to save a few dollars.
yeah.
But when a stock's on sale, we don't even touch it with a 10-foot pole.
Hmm.
Imagine you bought Facebook or Meta at $800 and now it's
Hmm.
at $600. Why would you? Yes, it came down to 200, but the moment you buy 600, you just average down your price. So you
Hmm.
are from 800, now each share is $700. So if it gets back to 800, you'll be up $200 because you have two stocks.
That's right.
And it's like most people don't even see it that way. And it's just like, oh my goodness, like what is not making, like, why is the math not mathing for you? Like it's so
Yeah,
simple.
yeah. That's right.
So today you are going to learn the wealth engine. Three strategies, one system. Buy and hold builds wealth. Swing trades create cash flow. Leaps scale opportunity. When I seen this in motion, it's an absolute game changer.
Hmm.
So the first level is buy and hold. This is the foundation. You cannot build a house on weak foundation. If you do not have this set, nothing else works for you because you're just going to continuously chase. Own great companies, hold for years, reinvest dividends, and build assets the bank respects. So this is part maybe three as to why this is a life hack.
Hmm.
When you go to the bank and you want a mortgage or get any sort of type of loan, the first question you should know this already because you used to do car sales.
Yeah.
Can you fill out a net worth statement for me? This is
Sorry if I.
Can you fill out a net worth statement for me?
Oh, net worth. Yeah, yeah, yeah,
Yes.
yeah.
Because they want to see that you have something. If you fail to pay, they can liquidate something.
Yeah.
Cash is the least of what they want to see on a net worth statement. It's worth the least amount. Cash loses value, and then that can be here today and gone tomorrow. But
Yep.
when you have your assets, those are sticky because you can turn around and sell those things. Banks like to see assets more than they like to see cash because
Hmm.
it's like, oh, this guy can't think. Let's take his stock portfolio. Let's go sell that. But it's like you got cash. That cash loses value on a daily basis.
Oh, for sure. Yeah.
So it's like, why would I want the shittier of the crop? Let me get the cream of the crop. I want the assets, the stocks, the life insurance policies, the real estate. That's where
Hmm.
the real money lies. And that's what you need to do. So that's why you build up a stock portfolio because 50,000 in stocks is far greater than 50,000 in cash.
Yeah.
Level two is leaps. So this is a wealth acceleration tool. So think of this like dynamite. This like blows up your account. It's long term. So Leaps is, I don't remember what the acronym is, but it's long term options, stock options. Are you familiar with that?
No, no.
Great. I'm going to teach you all about it today. Control more shares with less capital. Only on quality companies, only when risk is understood. So look at it this way. Imagine you go to Foot Locker and Foot Locker says, all right, studs, you can buy 100 pairs of Air Forces in the future for $100.
Hmm.
You just need to put down $50 today. Okay,
Hmm.
you got that part. So you're putting a deposit down to buy those shoes at a later date
Yeah.
for $100. A year passes now, and now those Air Force Ones are worth $200, or they're
Mm.
selling for $200. But because Foot Locker said buy if you put $50 down, you can buy it for 100. You now can buy those shoes for $100. So you now own 100 pairs. So to buy those 100 shoes, you'd give them $10,000. You now own 100 pairs of Air Forces that you only paid $100 for.
Mm.
But now you know the streets is selling them for $2 bills. So now you can turn around and sell each individual shoe for $2 bills,
Okay.
and now you make 20,000.
Mm. Okay.
Well, I didn't explain it right. If you sold them individually, you would make 20. Or let's say you just sell it to a wholesaler and then
Mm.
you'd make 20,000. Or because it's you paid 100 and now it's worth 20,000, you're up $10,000.
Okay. Mm.
So now let's say you go to Foot Locker, but you don't have the money to necessarily buy those 100 pairs of shoes.
Hmm.
Because the shoes have gone up in value,
Hmm.
that piece of paper you have or that contract that you have with Foot Locker, you can turn around and go sell it to somebody else. But you can sell it for more money. So you can be like, hey, I'll sell this. You'd be like, hey, Dean, I'll sell this, the rights to buy those shoes for $100 for $100. So I say, okay. So I give that to you. You now have $50 in your pocket on top of your 50.
Hmm.
I get the shoes.
Hmm.
Both equal 100%. So whether you bought the stocks or the shoes or you sold me the piece of paper, forget about the dollar value, both equal 50% or both
Mm.
equal 100%. You doubled your money.
Mm.
You made
Okay.
less, yes, but you had control of those. If you chose to buy those, you could have. But you could also choose to sell this piece of paper. And that's how stock options work.
So it's controlling the price of the stock.
It's the right to you have the right to buy it, not the obligation. So you're not obligated to buy it, buy the stocks. But if you choose to, you have first right to do so.
Okay. Okay.
Okay.
Okay.
And then the last part is level one is swing trades. I think I was supposed to change. Yeah, no, this is supposed to be level three. Level three is swing trades. So this is the cash flow generator. Hold for months, not minutes. Trade quality names. Use key levels. Use profit to buy ownership. So the simple allocation model is give your money a job. 70% is your buy and hold. So that's where the majority of your cash is going. So this is falling along the lines of the plan that you would use for your retirement. 20% for leaps, 10% for swing trades. Adjust based on risk and stage. So depending on where you are, but the first thing you want to start with is buy and hold.
Mhm.
The loop is simple. Cash flow feeds ownership. Swing trade creates profits. From the profits, creates profits. The leap accelerates the opportunity. Buy and hold builds the base, and then you repeat with discipline. So if you just do one, two, three, repeat, one, two, three, repeat, you just make money over and over again. So your profits need a job. You just don't spend them on material things. Most people, when they make money, they go and buy stuff. You don't want to buy it until you get to the point of I'm I I'm good at this level. I'm gonna pull some cash out now.
Mhm.
You're building a machine. But if you take out from the machine, you're slowing the growth of the machine. So
Right.
profits is not permission to flex. Profits should buy more assets.
Mm.
Assets buy back your time. Time is the real goal. When you have enough
Okay.
to be that's making more than your monthly income, that's your time when you say, okay, I think it's time for me to leave the job now because you're making more than enough. If you get to the point where you hit your freedom number, think of it, you had a large lump sum of cash and 4% of that annually could take care of you for the year. So if you had, say, $1 million, that's like 40,000, 4%.
Mm.
40,000, that should be more than enough to take care of you for the year. So that's how you kind of want to think of things. It's like I'm making a mill and I'm working at a job that's paying me 60, 70, 80,000 a year. Why? I just, I'm living
Yeah.
my life with what I have in my account. Like once you get your money up to a certain point, you don't need to be investing into risky stocks or any of those things. You can buy a GIC and get 4% every couple of months. That's
Hmm.
all you need. If you have once you hit $1 million, you only need 4% for it to grow 4 to 5% a year.
Hmm.
Because then that takes care of you and the money just keeps rinsing and
Yeah.
repeating. But most people think I need 20, 30, 40. No, that's just more risk.
Yeah.
No.
Sure.
Separate your accounts. Do not mix long-term ownership with trading emotion. One account, buy and hold, one for trading, one for plan for taxes, one rule for risk.
Mhm.
I seen this guy post something today. Yo, like I've never heard it broken down this way, but it was just so eye-opening. He said, we have drawers for our clothes. You have like your sock drawer, your boxer drawer, your shirt drawer. We segment our clothes. But when it
Right.
comes to our money, we only have one account. And it's like having a basket of clothes and not putting away those stuff because it's like it's just too much. If you
Yeah.
started separating your accounts and saying this account's for this and that, it makes your transactions so much smoother. Because now
No.
you're not just dipping into one thing to pay the other thing. So, three rules before trading. Simple, non-negotiable. Only trade what you understand. Only trade what you can afford to lose. Start small until you prove discipline. Um, One rule I like to say is, like people say, how much should I invest? Simple rule, and I think it's funny when I say it, but don't invest more or don't invest anything that you can't go to bed and
Yeah.
sleep comfortably. So only invest where it allow you to sleep comfortably at night. If you're
Mhm.
up at 2 in the morning looking at charts, you invested too much. Cut that down to half. It's too much money in the market. A system gives you freedom. There are six-figure earners who are still slaves to their jobs. High income is not freedom. Low expenses alone are not freedom. Ownership plus discipline creates options. So, did you see how the three stages work together? So you have the foundation, you have cash flow, and then you have acceleration. And then you just repeat.
Yeah.
So let's say you had 100, like, well, not 100. 100 doesn't really work, but let's say you had $10,000.
Right.
7,000 should be in your buy and hold because that's your long-term investment.
Hmm.
You want to take as much risk off the table as possible. So if you're investing in decades, remember that's a 94% chance of the upside. Yes, you'll have your up and down years, but if the further out you can look, the less noise you see.
Hmm.
Now your leaps, you won't be taking that many. Like leaps come and go. Like you'll probably do 3 to 4 leaps a year. So that's you holding a stock option for like, well, I'm gonna explain more, but for a long period of time.
Hmm.
That's 20%. 10%, so that's only $1,000. That $1,000 is what you can use to buy short-term contracts. That's about 4 to 6 months long. The money you're making from that funds the leaps. The leaps fund the foundation, and it just becomes a rinse and repeat cycle. So now we're moving on to the buy and hold framework. So this is where we get into the nitty gritty. So this is the note taking part.
All right.
So buy and hold is the foundation. This is where generational wealth is built. Buy good companies, hold for long term, let compounding work. Don't rush to sell your foundation. Warren Buffett, he started when he was 13 buying Coca-Cola.
Yeah.
He didn't hit his first million till he was about 40 or 50. And he just kept letting compound do its thing to where now he's a billionaire. The more you keep buying into these things, the more you will see. For you, if well, I'm assuming you understand the insurance game and whatnot. There's companies
Mhm.
that are publicly traded that
Yeah.
are insurance companies, and insurance is like one of the healthiest industries that's been around since the test of time. Like them and banks, because insurance invest in banks and banks invest in insurance
Hmm.
because it's a healthy risk. Like insurance, they're betting that we won't outlive our policies, or that
Yes.
so
Yes.
they're making all the money. So when they make money, guess what they do? They take that money and they invest in the banks. And then the banks turn around and lend the money. And then the
Mhm.
banks have to give them money. So it's like they're robbing Peter to pay Paul. So it's like, why not just invest in those companies, right?
Right.
Every stock must learn its spot, or must earn its spot. Just like the soccer team here, right? Your portfolio is not a junk jar. No hype picks, no random tips, no emotional buys. Every company needs a reason. Now, mind you, you'll see something on Instagram or TikTok or whatever social media platform you use. It may pique your interest, but go do your research behind it before you even say, you know what, I'm going to invest $1 into this, you know? So, quality company checklist. 5 things you want to see: strong balance sheet, competitive advantage, pricing power, growth, and profitability. If you check off all those boxes, that's a sign of a quality company. That's something that you want in your portfolio. So, strong balance sheet. The company is not drowning in debt. More cash flexibility, less pressure in hard times, more room to invest, more uh, more staying power. So a strong balance sheet would be like Apple. Apple is one of the few companies that has heavily invested into the AI technology, or into the growth of AI technology.
Hmm.
Their debt is very low. When you hear a company has very low debt, that's a healthy sign from that company, because if they have low debt, that means they have a lot of cash. Or they not necessarily they have a lot of cash, but in this case, Apple has a lot of cash sitting on the side. So if an opportunity does present itself, it can go out there and do its thing because it has money sitting on the side. But when you
Right.
hear companies drowning in debt, guess what? They have an obligation, and that obligation has to be met once a month or once a year, and they got to be paying that money. So you, not every company will have no debt, but you want to have low debt. So low debt is what you really want when it comes to the balance sheet. Competitive advantage. So in the stock market world, they call a competitive advantage a moat. So like I should put a castle here. So the body of water around the castle.
Yeah.
Yeah. So that's what they call the moat in the stock market. So it's having a competitive advantage. It's like, what does this company do better than others? Brand, technology, network, cost advantage, consumer loyalty. So what do you think Tesla's competitive advantages?
I would say their technology.
Yes. So
Yeah.
they came out, they're the first to come out with the cars.
Yeah.
They also have the charging stations. They're the
Hmm.
fastest charging stations. So that would give them a competitive advantage over other people who are trying to make electric cars. Pricing power. Can they raise prices without losing its customers? Strong brands can charge more. Loyal customers stay. Margins can improve. Inflation hurts them less. Perfect example. You'll see it on the internet. There people will complain, but they'll still go out and buy it. Apple. Apple
Yeah.
said they're raising their prices on laptops and iPads. And guess what? Parents are going to still buy iPads for their kids.
Yep.
Students are going to still buy Apples because Macs are built like a tank. Like you can't go wrong once you have a Mac. Like
Yeah.
they're built to last. Yeah, they're gonna pay a bit more, but they're gonna still end up buying it. Same thing with the iPhone. iPhone went from maybe 500-600 bucks to now almost $2,000-3,000 for the phone, and people want it. They have customer loyalty, and nobody's complaining. They're still buying it. Growth. Is the business getting bigger over time? For the most part, technology companies, they're all growing bigger and bigger because we're doing more and more with stuff. Facebook or Meta got the glasses, they have the wearables. Now they're getting into AI. They're doing more things to help with ads. They have the largest user base. Growth,
Hmm.
like just money coming in. So revenue growth, earning growth, customer growth, market opportunity. When you hear there's signs of revenue growing, or you hear YOY, year over year, and it's growing, that's a good sign of health. Profitability. Does a company turn sales into real money? Gross margins. Is the gross margins high? Like, is it above 30, 40%? Uh, Tech companies are like hitting anywhere like 60 to 80% gross margins, which is very good because now they have more room to do whatever they need to do after all their costs. Operating income, free cash flow. When you hear free cash flow, if you hear a company sitting on billions of dollars, good sign of health. Return on invested capital. So the money that's being put in, if they're seeing a return on it.
Hmm.
What makes a good stock? A good company plus a fair price. Strong moat, growing earnings, superior profit margins, high return on invested capital. So an example here would be Meta. Meta, its all-time high was about 700, almost $800. It's not $640. It's about 20, 25% below its all-time high price. Strong moat, Instagram, WhatsApp, Facebook, um, Threads. They have four platforms and they got over a billion users.
Hmm.
That's strong.
Yeah.
Now they have the glasses. They also have advertising. So they're making money. They got the users. They're making money through advertising. Now they have the wearables. They're making money. And now they have a few AI companies that they're trying to purchase or have purchased already. So there's more money to be made from them. So they have a strong moat because they have the customers. If they want to launch something to everybody, it's just a click of a button for them. Now, I don't know if you noticed, but if you have a WhatsApp business account, they're charging for broadcast now. So now you got to
Oh,
pay for broadcast on the business line.
wow.
Their earnings are growing every year. They have good profit margins from their ads. The only thing that's making the price go down is because they're spending so much money on AI. And in the news, everyone's saying AI is a big bubble.
Hmm.
To each their own. It could be a bubble, it could maybe not be a bubble. Who knows, right? But
Yeah.
it's whatever side of the fence you want to take. You kind of don't want to play that neutral side. You want to take a stance because if you play neutral, you're not going to do nothing. So buy damaged stocks, not damaged companies. A damaged stock has temporary price problems. A damaged company has business problems. Know the difference before buying the dip. So as you can see here, I put Meta again. So as you can see year to date, it's down only like a percent. It's not the end of the world. And it got as high as almost 750. So imagine Facebook gets back to 750. That's over $100 upside for me that I
Yeah.
could be making. The next thing is, so look at this company, Rite Aid Corporation, down 94, call it 95%, even though it's only like 3 cents. But look where their stock price is. That's not even a penny.
Yeah.
That's not even a penny. Why would you want to invest in something? It's like, yeah, you can buy a lot of those shares, but what's the likelihood of that stock coming back? Very far. So it's like, why waste your time with that? And if it went down even more, you're just going to end up losing your money.
Yeah. Exactly. Yeah. Yeah.
So damaged stock example. So the stock price is being hit, but the company's still strong. Business is still working, customers are still buying, earnings still strong, fears, market fear correct market fear creates discount. Meta only dropped because Mark decided to go on a call and said, "We're going to spend more money on AI." And they're like, "What? Like, bro, what are you doing?" Like, no. So that's why the stock price went from 750 all the way down to like below 550. Now
Yes.
imagine you if you bought at 550, that's 200 upside, especially if you're buying to hold long term.
Hmm.
Right there, there's already $200 that you'll make off of this, and it'll go potentially higher.
Yeah, because it's gonna go back up for sure. Yeah.
Damaged company example. So weakness, missed earnings, long-term decline, revenue shrinking, margins failing, leadership issues, stock goes down for years for a recession. So if you're seeing all flags pointing down, stay away from it. Like, why even bother wasting your time? Don't give yourself a headache, an unnecessary headache. So when do I buy? And this is like the $1 million question people ask.
Mm,
You
yeah.
need criteria, not vibes. You want to buy, you want to understand the fair value. You want to look for quality below fair value. There's something, are you familiar with EMA, SMA, moving day average, any of those terms?
No, no, no.
Okay, great. I'm going to show you what that is. So watch the 100 or 200-day moving average. Confirm earning strength. So a moving average is just a line. It shows the average price over time. And a lot of people, well, depending on who you follow or what you hear, they'll talk about the 200-day moving average. That's like the the godfather of lines. Like when a quality company comes near that or just below that, that's like it's indirectly telling you buy as much as you can of this company. Because
Yeah.
anything that comes down to the 200-day movement, 200 days, meaning you have to take 200 days to get the average. So that's a long time for it to get to that spot. But when it gets there, that's your opportunity to buy. So something like this, below the line can mean a discount. But if the business is still strong,
Hmm.
but only if the business is so strong, the chart supports the decision. The company comes first. So you do your background stuff. The charts is just added value to your decision. So let's say here, this is the 200, this red line is a 200 moving day. And
Yeah.
let's say it's a, oh, this is Hood. So this I don't know too much about, but let's say Hood is a quality company, but it has just been declining because of whatever's happening in the market with Trump and crypto, right? Because they do a lot of crypto trading, but it's a solid company overall. They're making money, and it's below this line here, the 200. More often than not, it will come back above this line. And when it goes
Mhm.
above this line, it's usually moving up in its favor. So something like this would seem like a discount, especially if it was at 120 bucks and now it's
Right.
at 90. It's like,
Hmm.
okay, great. My fundamentals support it. Let me buy this quality company at a cheap price.
Mm.
All right, so ETFs are a life hack, a professional diversification without picking stocks yourself. That is the one thing I like about ETFs because smarter people are picking these. But not every smart person is choosing the right stocks, right? However, it's professionally managed, diversified by design, grow with the market over time, reduce single company risk. So let's say you don't want to invest in all these companies. You get an ETF that has all these together, and then you have less risk. So it'd be 5 year, 10 year, 220, whatever it may be for your risk. Two websites that you can use today. Oh, let me just go back to this. The great thing about ETFs, it can
Hmm.
also tell you where money is moving towards. So let's say you wanted to buy Apple. You can go find what ETFs have a lot of Apple stocks. And if it's quality companies that have been showing a great track record, you can be like, okay, if all these hedge fund companies have Apple in their portfolio, why not just let me own it? Just do a single portfolio or own the single share instead of owning the basket of stocks. So
Yes.
that now I get more exposure to that from my buy and hold. So two websites that you can use today, not tomorrow, but today. So the first is ETF.com. So that was the question that you're asking about earlier. This is where you can go to find ETFs. And then you have iShares.com. After I'll show you what ETF looks like when you're like searching the stocks. But you'll be able to see the top holdings and then see the history of performance. So these are two good sites that you can use to find ETFs. And then you go one level further. Let's say if you wanted actual stocks to pick, you can see what's in those ETFs and then pick from that.
Okay. Okay.
All right, so the foundation helps you unlock more. Banks care about assets, not just cash. Assets show strength, cash can lose power. Ownership can grow. A portfolio becomes part of your financial portfolio. Oh, sorry, profile. So poor financial hygiene ruins good investing. Learning stocks doesn't fix bad money habits by itself. No emergency fund, too much debt, pressure, selling too early, needing market money for bills. When you are using money for that purpose, you'll lose more than you'll make money in the market because emotions come back into it. So you need more than just information. You need the identity, system, and access. Information tells you what to do. Identity helps you become the person who does it. And then systems make it repeatable. Access gives you support when confused. So did I just remove the guesswork around what to buy?
Yes. Yeah. Yeah.
Any questions?
No, it's very clear. It gave me a lot of insight on not only what to look for, but just how to think. Because so what happens that I had a stock before, right? I actually invested in Take Two Interactive. That's a company that
Yeah, yeah.
is
Rockstar.
GTA, right?
Hmm.
GTA 6 or whatever.
Hmm.
So at first the stock was selling at 212.
Hmm.
And I was like, you know what, whatever, I'll just wait. I'll buy it like next week, whatever.
Hmm.
So I waited and it went up to 230.
Hmm.
And then it went up to 240. And I was like, oh
Hmm.
my gosh. So I ended up buying it at 240, right? And I was pissed. I was like, man, I should have just bought it at 212.
Yep.
So this presentation pretty much gives me the idea of just don't be emotional, just pull the trigger.
Yeah,
So
exactly.
when it's there, just get it, right? And if it goes up, it goes up. If it goes down, it goes down. Just pull the trigger and get in the game,
Yeah,
right? So
it's that's a
just
it's there's a saying, it's better to have time in the market than trying to time the market. And that's what
yes,
most people do. They say, I'll wait, I'll wait. You're timing it. Stop that. Just get in there. So
yeah,
that
yep,
when it goes up, you're riding the wave with everybody else. Instead of just
exactly,
sitting on the sidelines being like, damn, I missed it again. And then FOMO kicks in, which is what happened to you. So I'm glad
yep,
that you're able to make that connection. So the
mhm,
great thing is, if that's a company that you're buying and holding for a long time, when it comes down, that's your opportunity to average down now. So instead of having it for 240, as it comes down, it becomes cheaper for you.
yep,
The rule of thumb is you want to buy at different levels. So when you know your levels to buy at, it's less emotion at that point. So right now, you say, all right, let's say the highest price it hits is 240. You
mhm,
use that as your benchmark, and then now you mark out levels. You can start at 5 or 10%, but you can say 5%, I'll put some money in there. 10%, I'll put a bit more.
mhm,
20%, I'm gonna put more in there. 40%, I'm gonna load the boat and put as much cash as I can possibly can. Just
mm,
so long as the numbers or the business makes sense, that it's making money. So
mhm,
again, if it's a quality company, when it hits those discounts, that's your time to buy in. For example, Microsoft. Microsoft's only getting hammered again because they're putting so much money behind AI. But Microsoft's down like $100, $200, but it's a solid company.
mhm,
So Microsoft's down $100. I bought it at $5 and it's now four and change. I'm buying as much as I can because it's at a low price. When am I going to ever see Microsoft back at this price? I don't know. Every every business or the majority of businesses all have Microsoft. Tell me I'm lying.
yeah, yeah,
They all use Microsoft. Microsoft
that's,
Excel, Microsoft Word, Microsoft PowerPoint, Microsoft Teams now. Microsoft's not going nowhere. People are still using that.
mm,
So quality companies fair value discounts, damaged stocks versus damaged companies. So now you understand the difference. Now this is part two. This is swing trade. Or it's actually supposed to be leap, but then swing. But this is where this is where you find opportunities. Now, this is not something that you have to do consistently, but if you have the time or you see something, you can use this to help grow your money fast. Like, think of this as like quote unquote your side hustle. It
mhm,
makes you that extra little cash that you can put away for when an opportunity presents itself. A lot of people miss out on opportunities because they have no cash. It's like, oh, I missed the COVID bubble. I missed this. Why?
mm,
Because you didn't have money sitting ready for the opportunity. Right now, mind you, he's retired, but his company, Warren Buffett, is sitting on like over $1 billion in cash.
no, yeah,
It's like, what? What are you waiting for, bro? Put that money in. It's like, nope. When an opportunity presents, guess what? He's going to be the only one with the cash to do so. Or everyone's going to, well, everybody's going to talk about, yo, I missed this, I missed that. The man's going to be like, I scooped that,
yeah,
bro. What are you
yeah,
talking about? I didn't miss out on it. You missed because you were too into the day to day stuff when I'm thinking decades to decades stuff. Because
mm,
as I said, Those only happen like anything below 20% doesn't happen that often. But
Yeah.
when it does,
Be
that's your
prepared.
opportunity.
Yeah. Yeah.
So swing trade is cash flow, is a cash flow generator, not a foundation, not a casino. This is where you hold it anywhere from 4 to 8 months. You trade quality companies, you use levels, use profits to buy more ownership. So you can use a bit of the swing trade money, put towards the long-term buy and hold, or you can put it towards the leaps. But some of that money has to come out of swing trade to put to those because the leaps, that's your opportunity money. The buy and
Mhm.
hold, that's your asset money. That's growing your portfolio. So we keep it simple. Three things matter the most: key levels, trends, volumes. Don't overbuild the chart. So key levels are what you trade, not the if the price is not at your level, you just wait. You mark your levels, and when I say mark your levels, I'm talking about support and resistance. Have you learned about that before?
No.
Okay. This picture doesn't really justify, but support and resistance is just like think of your floor.
Hmm.
The price has come to that floor quite a few times, and it bounces off of it. That's what you would call your floor. So the price is above the floor, and it's coming down to it. That's
Right.
your floor. And now you have resistance, which is the ceiling. So now think of the roof of your head. Price has come up to there, and it sometimes hit it and then comes back down.
Okay.
Sometimes it hits it and then breaks above it and then comes right down and goes up again. So support and resistance is just places where the price has gone before and it's coming back again, whether it be up or down. That's just all support and
Oh,
resistance is.
okay.
And then, yeah, I don't want to confuse you past that. So just floor and ceiling. That's all you just have to think of support and resistance.
Yeah.
So, like for example, up here, you see how these two candles are kind of at the same level?
Yeah.
That would be your area of support because
Mhm.
both came here, they hit the ceiling, couldn't go past it, so they came down.
Yeah.
Another way to explain it is, are you familiar when people say bulls and bears of the stock market?
Yeah.
Okay. The reason why they call it bulls and bears is because bulls go up because a bull charges with its head up. Bears, when they charge you, they charge with their head down.
Mhm.
So think of it bulls versus bears. When the Bulls hit resistance, they scored a point. Now the Bears are coming down to try to keep the price going down to score a point. So it's
Oh,
like almost like a ping pong or a tennis match. They're always trying to score a point against each other. But
oh,
sometimes one may be stronger than the other and break through that support or resistance and keep
right.
moving in their direction. So the next support is called dynamic support. So price pulls back to a moving average and holds. So remember when I told you about that 200-day moving average?
Yeah.
You more often than not, quality companies will touch it and then go and back up.
Hmm.
So that's dynamic support because it's taking a collective of the moving average and saying, based on the average, this is where price should come again. Now, it doesn't always hit that price, but when it does hit that price, especially when it's a 200-day moving average, it doesn't come there often. So it's
Yeah.
like that was your Black Friday chance. You take it and then it goes. So as you can see here, it comes close twice with these red ones, but not close enough. And then the moment it hits it, guess what? It turns around and it goes up. And it goes past those other points that it was before.
Hmm.
So trend is still intact. Price respects support. Volume confirms interest. Stop goes below that level. There's something called trends. And this I learned this rule and it's pretty much worked for everything that I've done. The trend is your friend until it bends. So as you can see this is moving upwards. They would call this an uptrend. If you see it moving the opposite way, they would call it a downtrend. The third move that stocks can do, they just go sideways, up and down.
Right.
If you see a stock moving sideways, you don't want to touch it because there's no real movement. It's just your money's, it's like your money's dead in the water. You
Right.
want it to be moving up or down depending on what you're doing. But for the most part, you want it to be trending up. So kind of stay away from down because the market, as I showed you from the numbers, the market moves up more than it goes down.
Yeah.
When you see something going down, it's more so a sign that company's trash. That's why it's
Mm.
moving down in price. People are just selling off.
No.
The third entry or second, is this supposed to be second? Oh, I guess we just started talking about it. So the second entry is a gap fill. So price to return to the area it skipped before. Look for a gap, wait for it to fill, watch for support. Do not chase early. This is kind of more advanced, but sometimes you see on the market there will be gaps in the charts. And what happens is, okay, so can you see my mouse moving here?
Yeah.
So the price closed right here. But
Hmm.
overnight, the market said, yeah, this is, well, lack of a better term. They'll be like, yeah, everything's great about this company. Like, let's buy some more of this stocks, right?
Hmm.
So because the market is closed and people started buying here, the market gapped up. And then when the market opened, so a green candle, they start at the bottom and then move up. Red candle started at the top and moved down. So because it moved up now, there's this gap here. And when there's a gap, there's a bunch of orders that people have placed, but they never got filled. So what happens is it goes up, but now it comes down because it wants to capture some of these orders before moving back up,
Yeah.
or it can continue to fall down. It can go either which way,
Hmm.
but 76% of the time, the price will come down and then move up.
Hmm.
But sometimes it will be the 20 something and it will go down. So this one you kind of want to be careful of and mindful.
Okay.
The third is key levels. So price returns to an important support or resistance zone. Old resistance becomes future support, and old support becomes future resistance. The retest matters. Stops go under this level. So this was the part that I thought wasn't here, but it is here. So what happens is, okay, let's start here. This came up and hit here. This is resistance. And then it came down because it hit resistance, it rejected it, and then moved up again.
Hmm.
So buyers are saying we want to move this price up higher, but then sellers are like, go fly a kite and push it back down. I
Yeah.
say, yo, let's try again. They said, nope. And they reject them and it comes down. There could also be a line here, but we'll just stick with this one. So now buyers saying, screw you, we're blasting through this. So this is resistance, but now that it blasted through this floor, this now becomes support because it's above this line.
Hmm.
Now it goes up and it comes down, it hits support and it goes up again. So when the stock price is above a line, it's support. When it's below a line, it's resistance.
Hmm.
So far, is everything clear? Any questions? Anything that didn't make sense that you'd like me to explain again?
Yeah, I know. It's clear. It's clear.
All right, good. So bonus entry, continuation. So this is more when you get familiar charts, but a stock retest and then keeps moving. So right now we kind of have a few, they call it like a parabolic movement. And
Uh-huh.
there's a few companies that are doing that right now. It's more in tech memory sector. Why? Because memory is in high demand. Very, very, very low supply.
Hmm.
When there's a lot of demand and very low supply, you can charge whatever you want. So trend is strong, pullback is controlled, volume returns, price breaks even higher. If you go look at a company called SanDisk, SanDisk started off at $20 last year. SanDisk is now $1,500. It's
Jeez.
it's unheard of. And I'm pretty sure you're familiar with SanDisk with the memory cards in phones and
Mhm.
cameras.
Yeah.
Yeah. So SanDisk is running, it's off to the races, but
Wow.
only it doesn't happen that often. But again, this goes back to time in the market versus timing the market. Let's
Yeah.
say, hypothetically speaking, I'm not saying it's going to happen, but let's say Rockstar GTA does way better than they expected, and they're making twice as much as they thought they would. That stock's going to take off. If they have like such a, well, mind you, they can't have a supply constraint because not everything can be put online. But if
Yeah.
more and more people are buying it, more people are spending time on there, or they introduce something that they can start making a bag of money, stock price is just going to go up. Well, because you bought previous, you're just sitting and enjoying the ride. Where most
Hmm.
people try to get on the roller coaster when it already took off. Stop loss protects your future. You cannot avoid losses. You can control damage. So think of it like a seatbelt. A stop loss is like your seatbelt. Most people, when they're in trading, they don't wear seatbelts. So
Hmm.
when the market crashes or the stock crashes on them, bam, there goes their face. Stop losses, you want to set it below key levels or 5% below the key level. So the key levels is these lines here that I showed you, which is kind of advanced, still advanced. You don't really have to do it that way. You can just say, based off of what I'm investing, how much am I willing to lose?
Hmm.
Uh, Swing trades should be a bit less. Leaps, you can do a bit more. Buy and hold, you're holding forever, so it doesn't really matter how the price. So know your loss before your entry. No plan, no trade. It's better to say where I'm okay with losing and losing that versus you saying in your head, okay, if it hits 20 I'm gonna cash out. 20 will
Yeah.
turn into 30, 30 will turn into 40, 40 will turn into you blowing your account. It's happened to the best of us. 95% of traders fail for predictable reasons. The enemy is usually behavior, not charts. No system, over leverage, panic, revenge trading, blowing accounts. So, how to spot a runner? So, this is your writer downer. Start with strength, not hope. Strong fundamentals, pricing power, growth trajectory, industry leader, beating the S&P 500 by 2 times.
Mm.
So let me go to industry leader. Again, going back to LeBron and Bronny. Are you choosing Bronny or are you choosing LeBron?
LeBron.
Because he has experience and he's leading.
Yeah.
Bronny doesn't have shit for his name. So why in the hell would you want to pick out Bronny? You
Yeah.
want number ones and number twos. If you just search in the market for those, that's all you need. Everyone thinks, oh, I gotta find that next Sandus. Like I spoke to this guy and I'm just like, the likelihood of you finding that company is like you playing the lottery and that happening for you.
Hmm.
That's how a lot of people think. But you could easily just find the leaders and just hold on to those. Like, why go through speculation if something's already proven that they can make money?
Hmm.
So beating the S&P 500 by 2 times. So if you go SPY or S&P 500 stock price, you can see year to date. If you click YTD, it'll tell you how much it has moved up. And based off of that, those are the stocks that you want to buy. So let me see here. Year to date, it's up 9%. Call it 10%. If a
Hmm.
stock is not up 20%, I don't want it. That's how you're spotting a runner because
Okay.
it's beating the S&P, meaning it's beating the top 500 companies combined. So it's a runner. It's something that you want to pick up. This is where you can get a Usain Bolt and
Mm.
beat Noah Lyles. Okay? So that's how you want to look at
Okay.
it. Runner signal industry. So runner signal, the industry leader. So I just explained that. So leaders tend to attract capital first. If it's running, more people are going to put money there. That's where you want to put your money. Recognizable position, strong demand, better margins, clear advantage. Right now, what's leading the market right now? What do you think's leading the market?
I would say technology companies.
Very good. And what within technology is leading the market?
AI.
Yes. So you're going to look for companies that are leading with AI. Now, this doesn't have to necessarily be for your buy and hold. This could be for your leaps or your swing trade because they move much faster. Yes, there's more risk, but if you manage risk carefully, you can have more losers than winners.
Okay.
I don't think that one caught you. You can have more losers than winners.
Hmm.
So if you lose 7 out of 10 trades, you can actually make more money. Because those three trades, you could make, say, three times each of those, that's nine. And if you lose only 10% on each of those and you take that away, you're still up two.
Yeah.
So you can have more losers than winners. It's just about
Mhm.
having your system proper risk management.
Okay.
So runner signal. So S&P is two times the S&P. Look for stocks that already have shown superior movement. Compare 1 year performance. So if the S&P is up 10%, look for 20% movers.
Mhm.
Strength often attracts more strength. Still check the fundamentals first. So once you see that it's 2x, you go back, you look at the fundamentals. You want it again. What you're doing is like you're creating a story for yourself to be like, why am I buying this company? Or you can ask the opposite, why shouldn't I buy this company? And if it's not hitting those checkpoints that you have, that's something that you don't invest in. You just move on to the next one. There's over 5,000 or 4,000 companies in the stock market. You will be able to find something. And
Yeah.
we've already knocked two or three. We already said maybe two companies that you can put on your list and three industries that you can look into. Runner. So a signal, runner signal pricing power. The company can raise prices and customers stay. A good indication or a good company or a good example of this company is Netflix. Netflix raised their prices on Americans, and guess what? Americans are still paying their Netflix subscription.
Yep.
Netflix backdoored people and said, "Oh, we'll give you a cheaper subscription, but you're gonna see ads." Guess what? Guess who makes up for that ad money? The people that want your eyeballs.
Yep.
So Netflix isn't losing, they're winning. It's like, oh, you want to pay cheaper? Great. Now we're gonna get some more ad dollars because you rather see commercials than pay us our premium. So strong brand, high demand, better margins, less fragile business. Imagine Starbucks raises their that cappuccino macchiato or whatever. Well,
Yeah.
you're gonna still buy it.
Oh, for sure.
So next runner signal, growth trajectory. The story is getting better, not worse. Revenue is growing, earnings are improving, industry 10 trend helping, more demand ahead. Demand came. So there's a company that is in competition with SanDisk. The man came on and said, "Oh, we got contracts coming in till 2028. We're in 2026. The man
Mhm.
has future revenue for 2 years. There's too much demand. We can't keep up." That's a healthy sign of a company. Two
Yep.
years contracts,
Yep. That's real good.
if they're ranting and raving about their earnings and everything's good, that's where you want to put your money behind. When I
Okay.
listened to Google's earning call a couple months ago, they said, "Oh, revenue's more than we expected. We're making more money. We have more users." That's all good sign of health. Now, this
Okay.
call may not be the same. That's why they do quarterly calls, but that allows you to understand where the company is. And the great thing is, you can listen to these calls. So after earnings happens, you can listen directly to these calls anytime that you want. Runner, so volume. So big money often leaves a footprint. Rising volume, clean breakouts, support holds, institutions may be accumulating. When it hits here, this is not your sign to buy. You already lost. You already missed the boat. But when you start to see volume low, that's a sign that something's coming soon. You don't know when, but something's coming soon. And when it comes, boom, it takes off. And you start making that money.
Mhm.
But when you do see volume, like that's a sign of, okay, money's flowing through this company. Start small and scale in. Add when the trade proves you right. Small position first, let the price move in your favor. Add near confirm levels. Never average down emotionally. So if the stock is moving down, most people would average down, but only average down in your buy and hold, not in like your leaps, unless it makes sense to, and not in your swing trades. If
Okay.
you, let's say you buy into something today and then next week you're at 100% and it comes down maybe 10, 20% and you still got like 9 months to go, buy another leg to go up, or take
Mhm.
some profit off the table and just keep locking in your profit as it moves higher and higher up. That's how you should do it. But most people do it
Yeah.
in the opposite way. Price keeps coming down, they're trying to average down. You average down to a point where it's only worth a penny. Now you lost everything. So you want to
Mhm.
average up, but then you want to average down in the leap. More so the leap. Swing is iffy. I kind of would stay away from that one.
Mhm.
Averaging in, but definitely buy and hold if it's coming down. That's your opportunity so that when it comes back up.
Yeah, you could profit off of it.
So swing trade checklist. No checklist, no trade. You want quality companies, good financials, high rate of movement, not speculative, entry, stop, and target. You want to set those before you even get in for the swing trade. And that's anywhere from 4 to 8 months. You also kind of want to know what season the stock market is in, because right now we're coming to a time where the stock market kind of starts to go down. Like August is not really a good month, and September historically is not a good month for stocks, and they usually come down. So
Yeah.
it's always good to learn about the just the overall stock market on how it moves. Like right now, they say midterm election stocks usually go down around the midterms and then come back up after. So you kind of
Mhm.
want to understand what's the sentiment of the market for that month.
Mhm.
So July's kind of been wishy-washy, but we'll see how it ends up.
So with it going down in like August, September historically, wouldn't that be the best time to buy?
Yes, depending on the company. But the company, yes and no, because it depends on where the price is. Like
Mhm.
if Facebook hit an all-time high and only comes down like 1%, it's not a good time to buy.
Yeah, it may not be the best. Okay.
So you kind of want to, it depends on the company and where it is in price. So that's why
Hmm.
it's good to set levels. And if you set alerts, you don't have to think about it or even look at the stock. Your
Yeah.
phone will tell you when it's time to get in. Your job is just to pile enough cash to buy when it's ready. All right. So, do you know how to spot a better swing trade candidate?
Yeah.
So, runner traits, key levels, stops, small positions first. Any questions so far, or anything that didn't make sense?
Oh no, no, you're good. You're good.
All right. So now here's the third and final stage, the leap options, and this is where your mind just goes. So leaps are not lottery tickets; they are long-term um, tools for quality companies. I'll actually tell you what leap means because it's killing me right now. Long-term equity anticipation securities. It was the A I could remember. So long-term, oh, it's actually here. Long-term, it was right in my face. Wow. Long-term equity anticipation securities. This is where you usually hold anywhere from 10 to 12 months plus. More time than short-term options. Still risky if used wrong. One thing I didn't mention
Mhm.
about stock options, they have expiry dates. So when it gets closer to the expiry date, the price of your contract becomes worth less
Mhm.
if it's not at the price you wanted it at or above it. If it's below it, you will start to lose money much faster. Okay? The great thing about long-term leaps, you can go 3 years out. So let's just use Take Two. Let's say you bought a stock option on Take Two, and
Yeah,
Grand Theft Auto is supposed to release this year. So you know everybody's going to be playing that game for the next couple of years, right?
of
And if
course.
they can introduce something like how they have in Fortnite, let's say tournaments or something that just out of this world, and
Mhm.
let's say Take Two comes down to like $2, and you buy a stock option, and you hold it for 3 years. That's 3 years that the company has to get to back to 240. If it gets past 240, you start making more money.
Mhm.
And how options works is you're holding the rights, but let's say for every dollar that Take Two moves up, you make 50 cents.
Right.
And as it gets closer to the price you said you think the price is going to get to, you
Hmm.
start to make more. So let's say you say 240 and it hits 240, but now it's past 240 and it's at like 250.
Hmm.
Now, every time that the stock moves up, you make $1. But
Oh.
because stock options are in baskets of 100, you're actually making $100. So every time it moves up $1, you go up $100.
Hmm.
And if you have multiple contracts, you just make more and more each time.
Mm.
So that's how come it accelerates your growth at a faster rate. So it makes money faster than you can work for it.
So
That's
it gives you more control in that aspect then.
not really because it could go against you.
Hmm.
But if it's a quality company and the longer time horizon you have, the more likely it'll go into your favor. And when you start researching companies and understanding businesses and finding the discounts, then you just have all that upside. So, for example, Facebook, as I said, Facebook is making money. They're only getting penalized because of how much they're spending in the re the AI revolution. But
Yeah.
if that AI revolution pays off for them, that stock price is going to shoot so fast up. People won't even, by the time you blink, you already missed it. But if it doesn't pan out for them, then they'll lose money. You'll lose money faster than you can even blink.
Yeah.
So it can go both ways. So that's why the research part is so key. So what is an option? It's the right, not the obligation to buy or sell a stock at a set price. You control 100 shares per contract. You pay less than buying the shares. You can still lose the premium. Risk must be planned. So the great thing is, if the stock goes down $10, you don't lose 10,000. It will just take it off of what you have. You can go down to zero.
Yeah.
However, or not however, the other thing about stock options, you can actually buy for stocks to go down in price. So if you think the stock's going to go down in price, you can actually buy a contract for it to go down. I don't like to play that game because the stock goes up more than it goes down, depending if it's a crappy company. But
Hmm.
I just stay where the odds are in my favor. So I'd rather for it to go up than to go down. Mm. So why people use leaps? Control the same shares for a fraction of the cost. So imagine you have 100 shares. You want to buy Facebook at $500. 100 shares would mean 50,000. The easy way to do that without putting up 50,000, it's like leveraging. So it's like when you buy a house, you're leveraging because you're only putting down a certain amount of money. But in this case, you're paying way less. So a leap contract costs far less than the actual stocks. More leverage, more responsibility. Tech stocks are kind of more expensive because they
Hmm.
move faster. Yes, you put up a lot of bread, but the amount of money you can make is stupid. You're gonna ask me something?
No, I was just saying it just actually clicked to me about options. So
Mhm.
it's like that movie, The Big Short.
Yes,
If you
that's what he
watched,
did.
yeah,
So
okay.
he
So
shorted.
that's yeah.
Everybody was saying, no, all the bonds are gonna go up, and he's like, no, it's gonna go down. This doesn't make sense. And then he shorted
And
the market
yeah.
and made a shit ton of money. And now he's kind of seen like the Deborah Downer guy, but
Hmm.
he can be wrong. He can be right in some instances about this because right now he's saying a lot of companies are in a bubble, and because his reputation from The Big Short, he's kind of one of like those market movers now. When he
Mm,
talks, the market shifts because now
yeah.
he's like, oh, this isn't a thing. This company's gonna go down. I'm betting against it. So a lot of people are trusting his judgment because of that movie. So now he has say. It's just
Yeah.
like Warren Buffett. Warren Buffett says something. Warren Buffett sneezes, the market moves. Elon
Mm,
sneezes, the market moves. When these guys talk, they can move. When
mm,
people have that much power, you want to listen close to what they say.
yeah.
Biggest person right now that's moving the market heavily, Donald Trump.
Oh yeah. Yeah.
Every time he talks, market goes down or it goes up.
Hmm.
Funny enough, he's trying to make people rich. Like the man saying go buy these companies. He literally said go buy Dell, Intel,
Hmm.
IBM, um, Micron, and a few others. And every
Yeah.
time he said that, boom. up.
Of course, because they're more so American companies, right? So it's gonna
Yeah,
help out.
he's like buy make America great again. So buy
Yeah,
into American companies. If you're not with them, you're against them.
yeah.
So because he's saying that, on top of that, he's actually investing in these companies. Hey, stop it. He's actually investing in these companies. I think they said he did like 3,900 trades since January.
Mm,
So that goes to show you he's
yeah.
literally telling America what to invest in. And most people are not even listening. So think of leaps. Hold on. What do you need? Go upstairs, please. Go upstairs, please. Then go bathe. What are you still down here then? Sorry.
Yeah.
So think of leaps as dynamite on your buy and hold. Powerful when handled correctly, danger when careless. So when you understand the market a bit better, you will know when to deploy a lot into the market and when you should be pulling back.
Mhm.
Quality companies first, discount entry second, contract selection third, risk control always. And that's the order of your operation for your leaps. So if you see a company that's quality, again, I'm just telling you companies that I see so that you can understand.
Right.
Microsoft, Meta, down heavily. But if you don't got money for those companies, you can't buy those leaps. You just got to sit on the sideline and just wait. However, you can put them into your buy and hold. So you do not buy leaps when everyone's excited. That's the wrong time to buy. So, like example, a leap contract on like SanDisk wouldn't make sense right now because it's up 1,600%. You want them when the quality is discounted. Market fear, strong company, price down, business still improving. That's what you want to when you want to buy. The biggest money is often made in phase one when everyone is still scared, but improvement is beginning. So think of it like the seed just got planted and it's this is its first stem that's coming up. So market improves quietly, behavior shifts early. Most people do not see it yet, and risk is still real. I'm not talking to you again. One sec. All right. Phase two, setup starts working. More people notice the improvement. Price action improves. Breakouts hold. Leaders move first. Confidence returns. When everybody stops saying we're in a bubble, or if these companies start to make money based off of how much they're spending in AI, you're going to start to see a big shift in the market. If they all tank, yeah, boom, stock market crashes, then it rebuilds, and then we're up again. Phase three, everyone sees the rally. This is where danger increases. Stocks become more expensive, hype raises, people chase, risk reward gets worse. The perfect example of this is when COVID hit in 2020. The stock market dropped like 34%. And then
Mm.
after that, it rose and everybody was buying, thinking that they're a genius. And then the following year, everything started to drop. So, step one is build a quality watch list. This is the part most people get wrong. They think that they need 50 companies. I don't even, depending on what you're doing first, but your buy and hold only needs 4 to 10 companies. You don't need more than that. Your watch list can have 10 to 20 companies. So you're watching only those 10 to 20 companies. You're
Yeah.
not necessarily buying into them, but when an opportunity presents itself, it's on your list and that's it. So you're
Mm.
going through the same stocks over and over again. You're condensing 4,000 into 20 max. My list is kind of stacked. I'm trying to see where I can trim it each time. But once you have 10 to 20, that's all you need. Because now, again, we're creating a system. You're just rinsing and repeating over and over again. And you only want quality companies in your on your watch list. Strong fundamentals, industry leaders, clear business models. So think of it like you're picking an all-star team. You only like there's I didn't mention this before, but there's only 11 sectors in the stock market. If you find what sectors are leading the stock market and just pick based off of those, you kind of want to have stuff that are not correlated with each other. So it's like if you buy tech and then you buy, I don't know what's correlated with tech, but let's say it was banks. You don't want just those two because if one goes down and the other goes down. But if you have different companies in different industry and sectors out of the 11, if some's down, then you move on to this sector. I kind of say you want to have it like a market cycle. So there's
Mhm.
four different market cycles, and each of those sectors leads it when it's in that cycle. And when you can identify those cycles, you're just following the money. So it's like, all right, financials are down, tech is up. Let me put my money into tech. Tech is down, consumer defense is up. Let me put my money there. And it's just a
Mhm.
rinse and repeat. It's just over and over again. You have your companies. What people are saying out in the streets, that's noise. That's to distract you. Because now if you get distracted, you fall off course and then you start to lose money and be like, why did I invest in this? I know nothing about this company.
That's
I know
right.
everything about this. Why am I going anywhere else? If that makes you money, why the hell are you going over there? It's like you
Yeah.
working at your company and then going to work at McDonald's. Why?
Yeah.
Your company makes more money. Stick to what you know. Why are you flipping burgers for? Because you're gonna make a little bit more here? No. Stick
Mhm.
to what you're already doing. So quality companies only, strong fundamentals, industry leaders, clear business model. Step two, wait for the discount conditions. So leaps again only happen about 1 to 3 times a year. So right now, strongly believe when Netflix or when Facebook gets back up, we're not
Mhm.
seeing 500 again. Netflix is down, but when Netflix figures out their ad strategy with AI and they sign more contracts, you're not going to see that $60 again.
Mhm.
Netflix hit $1,400. The only reason why it's 60 something dollars now is because they did a stock split. When companies do stock splits, they want more people buying their stocks and they want to make it look more attractive for everyday investors.
Yeah.
When companies do stock buybacks, that's a sign of good health. And when they take shares out of the market, that increases what you make per share. So when you hear a company's doing $6 million in buybacks, that's good. Netflix bought back some shares. I know once Netflix gets it, it's gonna go back up. I don't know where it's gonna go to, but it's gonna eventually go back up. And if you're buying for the long term, that little
Mhm.
noise now doesn't mean shit. That's just your opportunity to buy more and more.
More.
So
Okay.
below key moving averages, near support, market fear, business is still strong. Then the third is choose a contract. Simple beginner rule. First or time first. So you figure out where you're gonna be buying this contract. Is it 8 months? That's kind of like in between the leap and swing, or 12 months out. That's your minimum. 8 is a minimum for a leap. 12
Mhm.
months plus is good. You can buy out into 3 years. The further out you buy, the more expensive the contract becomes. The closer to the expiry date, the cheaper that this contract is. Like you can buy contracts for like a penny, but it's going to
Mhm.
be worth nothing. You can buy contracts for like $100,000. Those are going to be worth something, especially when the market moves. Strike price. So what the strike price is, that's like you saying, this is the price I think the stock will go to in the future. That's a strike price. Okay.
Okay.
Check liquidity. So liquidity is how much people are buying into the stock. If nobody's buying or a stock option,
Mhm.
nobody's buying into the stock option, it's not something you want to touch. You stay away from it. Know your max loss. If you're gonna invest $1,000, how much are you okay with losing? The most you want to lose, in my opinion, is 30%. Because then you still have enough to get back in and make
Mhm.
that money back. But you're not going to get in for the sake of making that money back. It's just saying 30% is what I'm going to take. Another rule of thumb is depending on how much capital you have, you invest 20% into something, and of that, you invest 20% of that. So let's say you have $10,000,
Yeah.
20% you would invest into a long term leap contract, 20% of that 2,000 is
Hmm.
what you would risk, which is $400. So if
Okay.
you lose that $400, overall in your account, you only lost 4%.
Okay. Okay.
So that's how you do it. So you do 20 of 20.
Okay.
And that's how you can kind of minimize your risk. Second thing is, if you did have $10,000, if you bought five leap contracts, and let's say four of them do good and one does bad, you'll make a lot of money. Trust me. Especially if it's a quality company, you'll make a lot of money. You can go from 10,000 to 40,000 in like a year, and you'll be like, damn, like I never thought this was possible. Step four is take profits at milestones. Don't let a win turn into regret. A lot of people have gone through, well, you said you were trading before, right? So you
Yeah.
probably have gone through this. I've gone through this so many times I don't even like counting. So what you want to do is, so this is like a two-part strategy. If it's just one contract, you want to, at 50%, consider taking some profits. You can, when you're doing one contract, you want to lock in the profits at 50%, or you can say, all right, I'm coming out of this trade. I'm okay with the 50, and I'll move on and look for another opportunity.
Hmm.
Or if another opportunity arises and I already have money in this, then I can take out of this to move to another one. If this one runs flat. You always want to protect your position, remove emotional pressure, keep following the plan. When you can get to four contracts in one company, four option contracts,
Yeah.
that's when it becomes life changing. Because the first moment you hit 100%, you take two contracts off, you got back all your money you put in there. Now you
Hmm.
have two contracts, that's all house money. When that next contract hits 100%, you take that out. Now you have one left, and you let that run all the way until the end of that contract or 30 days before that contract expires. So you make a whole bunch of cash in between that time. And that's the strategy that you'll just rinse and repeat over and over again. Next is add only when it proves itself. Do not add because you're hoping. Pullbacks, pullback holds key levels. So the stock shot up and then it comes down a bit. So stocks have to go up and down. Not so much like if they go down and up, they don't come up that much, but just always thinking in the direction of up. It's healthy for it to go up and then come down a bit to go back up. It has to do that. If it doesn't, then it's just going to go straight up. And then when it comes down, it's going to crash hard. So pullbacks hold key levels. Trade remains above plan. Setup confirms. Add another leg carefully. So you want to be mindful when you're adding another one
Hmm.
to your position. But that comes with experience. Start with what you're comfortable with, one contract, before you move into the next. Always keep moving. Always keep money on the side. You cannot re-up if you spent all your buckets, all your bullets. Cash gives you options. Cash reduces panic. Cash lets you buy discounts. Cash protects your mind. So again, if you have 10,000, you don't want to put all of it into the market. Leave some on the side, a couple of thousand, because if an opportunity presents it and you got all your money in your market, there goes your opportunity and you're gonna be kicking yourself. But if you leave that on the side now, it's like, oh, there's a leap option. Bam, you get it, you
Yeah.
ride the wave, you make your money. So leaps versus swing trade. So they're different tools, different jobs. Leaps equal wealth building tool. Hold for 10 months minimum, 12 months out. Swing trades, that's for cash flow. So you hold for anywhere from 4 to 8 months. So when you're in a swing trade, you don't necessarily have to hold for that full period. If you hit 100% and that was your plan, then you just move on and go look for something else. Or you
Hmm.
lock in at 100% and let the market do its thing until you find your next opportunity. So benefits of a leaps. Used correctly can accelerate the wealth engine. Multiple profit opportunities, less capital than shares can reduce pressure when planned. Potential to scale faster. So, do you understand why leaps require patience and quality first?
Yeah.
So, quality first, discount second, time third, risk always. So, we covered the full system. Now you have the entire blueprint. So, you have, I like to think of it like almost like a tribal offense. So, you got
Hmm.
Jordan, Pippen, and
Ramen.
All right, Rodman. That's your three, right?
Yeah.
You keep that in check, you will make money. So now you turn that information into a decision. What to buy, when to enter, when to exit, how to spot runners, how to find discounts.
Mhm.
So your first task is pick one you already understand. Not the hottest stock, not a random tip. One company you use. You know that you can explain, then you run the checklist. So you mentioned take two, but is there something else that you know, like, trust, or have been watching?
Not when it comes to just stocks or just products in general.
You can go with products and then we can find a stock for it.
Oh, well, products we could say Apple.
All right.
Uh, yeah, we could go with Apple.
So you have Apple. What
Mhm.
does Apple do?
They build phones, dual technology. They're a tech company, so
Perfect.
phone. Yeah.
If you can't explain it, then it's not something you want to be touching. So based on everything that we did, you can apply that to Apple to see if it makes sense to buy.
Hmm.
So run the quality check. Does this company deserve your money? Does it have a balance sheet? Does it have a moat? Does it have pricing power? Does it have growth? Does it have profitability? Yes. Decide the strategy. Do not force every stock into the same box. It's either a buy and hold, a swing trade, a leap, or a pass, or a watch list. So write the one sentence thesis. If you cannot explain it simply, you do not understand it yet. I am buying, watching, or passing because the main risk is I will change my mind if my next action is.
Hmm.
So Apple has earnings coming up. That's something you want to look out for to see what happens. Also, September, that's when Apple usually releases their new phone. So these are things that move the market. And if you can understand, like, hey, let me set some money aside for Apple. Apple hit an all-time high last week. It came down a bit, not too much. So it's like if you're buying to hold, yeah, I don't even think it came down 5%. You maybe want to wait a bit. But seeing what happens during earnings, what happens during their conference, or not conference, the release of the phone,
Right.
gives you an idea of what you should be doing or where to enter into that market.
Hmm.
Now here's the problem. Doing this once is easy. Doing it every month is where people quit. Research takes time. Emotion creeps in. Markets move fast. Accountability disappears. So I'm giving you a faster tool. So I created something on Claude, and I'm going to give you a report after this. Um, it's the fundamentals report skill. And do you have Claude?
No, I do not.
Okay, so I'll send you the report.
Yeah.
So you generate it helps generate fundamentals report faster, summarize the business, checks quality factors, and helps you prepare before making a decision.
Mhm.
I was supposed to take these things out, but couldn't even think. AI speeds up the research, but it does not replace the discipline. You still need the frameworks, the rules, the accountability, and you still need to execute. So, have I delivered on my promise so far?
Yeah.
Did I give you clarity?
Yes, definitely.
Did I give you practical tools?
Yeah.
Did I give you a system?
Yes.
Can you apply something today?
Yeah.
Perfect. So, here's the do it yourself path. You can take everything from tonight and apply it on your own. Build your watch list, run a checklist, study the charts, choose the strategy, review every decision yourself. But here's the honest part, most people don't fail because they lack information. They get overwhelmed, they second guess, they freeze, they break their own rules.
Hmm.
You do not need more information. You need support while executing. Someone reviews your decisions, someone challenges your emotions, someone keeps you accountable, someone helps you stay in the system. So this is why I created Think Like an Investor Accelerated. It's a
Hmm.
6 week course, 1 year working with me closely. So that's 1 year support after the 6 week course. And that's me teaching you one on one. Decision support, accountability, and execution. The 6 week course Obviously, we help build a system together. So the first, and you pointed this out, investor mindset. Then the second week is the wealth engine and portfolio setup. Then we go more in depth with the buy and hold framework,
Hmm.
swing trading framework, and then the leap framework. So 1 year support is the real value because the market will test you after the course ends. When you're unsure, you can ask me. When earnings come out, we review. When the market drops, we plan. When you find a setup, we check it. Every investment decision this year, you do not have to do it alone. Buy and hold
Hmm.
questions, swing trade reviews, leap setup reviews, portfolio direction, mindset, and accountability. So the bonus is the Cloud AI fundamentals report skills. So research faster before making a decision. So this report I created just to kind of help me with putting everything together instead of me having to go look for the numbers.
Right.
Mind you, sometimes AI can be wrong, but it gives me a lot of what I need. And then I can challenge it to see or go find that information myself to see if it's accurate and whatnot. But it kind of just condenses everything in one spot.
Hmm.
So business summary, quality checklist support, risk and opportunities, and faster prep before coaching calls. So this investment is $2,000 for the year. It's a 6 weeks implementation program, 1 year support, frameworks, review, and accountability, a system that you can use for years. So this is not a course, it's a year of better decision making. So
Hmm.
my program is more so based on the decisions you make more than me spoon feeding you stocks and then you depending on me. Because
Yeah.
once you become a better decision maker, you'll be able to spot these companies like the back of your hand and be like, that's a company I need to invest in. There's a runner right there. And you start to do that over and over. And having a mentor is the cheat code a lot of people miss out on
Hmm.
because you can do this on your own, yes, but oh, we don't really need this part. You can do this on your own, yes, but how many mistakes are you going to make before you say, you know what, I'm done making these mistakes. I need to reach out to someone or I need to find a way to not make these mistakes because it's 2000s today, but how much will it really cost you to learn this on your own?
Right.
All the
Right.
mistakes you make. So it's like if you start to weigh it, the cost of not knowing how much is that going to cost you?
Mm.
It could be tens of
Oh,
thousands of
yeah.
dollars.
Yeah.
So when you understand that concept, now you can be like, hey, and the great thing is, what I'm teaching you is not something where it's like it's done here. Take what you learn, teach others.
Yeah.
Because that's what we're supposed to do. You learn something, you teach others. You don't keep the information to yourself.
Hmm.
The only reason I charge people is because when people pay, they pay attention. And when you pay more attention. But when you give people stuff for free, aka Instagram,
One help the other. That's right. Yeah. Yeah.
so when you put stakes, when there's a stake on the line, you're like, okay, I put my money up, I don't want to waste it. And what's funny is people say that when it comes to programs like this, but they spent tens of thousands on going to school and don't even work in the industry that they
Yeah, exactly. Exactly. Yeah. 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 Yeah.
make it make sense.
It's true, man. It's true.
Yeah. So that wraps up my presentation.
Mhm. Awesome.
Um,
No, man, that was good. That was good.
mhm,
I learned that what type of investor I am.
mhm,
That's my main takeaway
mhm,
today is learning like because I didn't know before like what type of investor I am, and now I know. I'm
mhm,
more long term.
mhm,
Like I'm not buy and sell
mhm.
like that.
Yeah. So
More like low risk.
mhm. Yeah,
Yeah.
you take what I give you, you do that.
Yeah.
If
Yeah.
you're a thing, you don't even have to touch swing trades. If you just see the opportunities, it just accelerates your portfolio growth when you do the leaps. And the great thing is, I kind of look at options as a cheat code that most people don't even realize. Because
Yeah.
let's say you do want to buy, you want to grow, you want Apple to be in your buy and hold portfolio.
Hmm.
You need to mark off milestones. First 100, then 1,000, then 10,000 shares, and that should be enough to take care of you, or even 100,000, right?
Hmm.
When you buy stock options, and let's say you buy a leap for 3 years from now,
Right.
and the stock is $300, you need $30,000 to buy 100 shares. Because you now have the leap, you have 3 years to save up $30,000. So now, if Apple hits $600 in 3 years, you get to buy it at $300 for
Dollars.
30,000.
Yeah.
And now guess what happens? You say I'm going to exercise my right to buy those contracts. You put 30,000 into it, but the stock is worth 600 or 600 now. Now you're up
Mm.
$60,000 automatically. Now guess what?
Yeah.
You have $60,000, but you only put up 30,000.
Yeah.
And let's say you want to go buy or use that money as a down payment or something for a property. You now already have access to 60,000.
Yeah.
60% of that, I don't know what that number is, but let's say you could take out 40,000 of that. You
Mhm.
can now take out 40,000 without having to sell the asset. So as it keeps going in price, you still make money. The great thing is you bought it here, or you took a loan here, or sorry, you took a loan here,
Yeah.
but now the price is going here. You still control that. So
Yeah.
as it go up, that doesn't mean the bank gets any more. Your equity is still growing.
Hmm.
So now as you pay down that loan,
Paid for itself.
that's it.
Paid for itself. Mhm.
So
Okay. Yeah, man. Yeah, man. That's good. That's real good. Yeah, man.
let's see how long it took me to do. 2 hours. All right, I'm under time. I thought it was gonna take 3 hours again.
Don't kill me.
Yeah. So
Yeah.
where do we go from here?
Yeah, man. Let me digest everything.
Mhm,
Right. Let me give it some thought. Usually I think things over before like I pull triggers and stuff like that. But yeah, let me give it
right.
some thought. But the course, well, today was good, man. It was really good. It gave me a lot of insight. I learned a lot,
Mhm,
especially the aspect of the emotional thinking of everything,
mhm.
right? And just going through emotions of buying, selling, up, downs, and yeah, man, it was really good. It was really good stuff for sure. Mhm.
So, question for you. So yeah, take all the time that you need, but more time usually means more avoidance. You do not need perfect timing. You need a decision process. The market will not stop moving. Your habits will not fix themselves. So when people say they need more time, that usually means something wasn't answered. So what questions have I not answered?
No, 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 no. You've definitely answered the questions
Hmm.
that I had in mind.
Hmm.
Um, yeah, I mean, again, it gave me a lot more clarity on the type of investor that I am as well, which
Hmm.
is really good because that was one thing I was always trying to figure out, like
Hmm.
what I'm more comfortable in doing,
Hmm.
and it looks like the ETF strategy is more so like my lane way,
Oh yeah,
right?
that's what I was supposed to show
So,
you, ETF.
mhm.
Okay, so how much time do you think that you need before making a decision? And then I could follow up with you. Let's see here. TF2 is my portfolio. SMH. That was a question for you.
Sorry, what was the question? I didn't hear you.
How much time do you need?
Oh, just give me till the end of the week. Yeah, it should be good by then.
All right, so let me show you this here. So ETF, let me actually go back to the beginning. So let's go IBIT. I don't know what this is. Or is there any ETFs that you've heard of?
No, no.
Okay. So here's IBIT. I don't know what they
Mhm.
do. Yeah. So- Oh, this is into BTC, so this is into crypto. I'm going to holdings. Oh, they want me to stay. Before they didn't, I didn't have to sign up. See here. What if this was IBIT? I'm pretty sure it's free to sign up, but let's go QQQ. So QQQ is technology companies. Okay, so they want you to sign into this, so you'll have to sign up. Let's go
Hmm.
do it. Oh, that's not what I want. We go to holdings. So Yahoo.finance is another site that I use.
Okay.
So you see here top 10 holdings of total
Yeah.
assets. So Nvidia, Apple, Micron, Microsoft,
Right.
AMD, Amazon, Tesla. So QQU is more so technology, but they also have consumer cyclical, consumer blueprints. So these are all the sectors. Bless you.
Thanks.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So there's 11 sectors, and it tells you how much they have invested in all of these. So here, let's just go to the top three. You see, these are the top three. So you mentioned Apple. Apple is number 2 in this sector. So you can
Hmm.
go into Apple. I don't remember exactly where to navigate for this, but you can find out what other ETFs Apple sits in as well. I just don't remember where to go. Um, Maybe folders. But you can find a lot of information on this site too. You can even find out which investors are investing in these.
Hmm.
The top institutional holders. When you sign to the ETF site, you can find out more.
Hmm.
If you want to see option contracts, you click options, and it'll tell you the price of thing.
Okay.
So this is the option page. So let's go up to next year. So this is June next year, roughly about a year from now.
Okay.
The price is like 300 something right now. So let's say next year we believe it's gonna hit that. It's gonna hit $330.
Mhm.
To buy this, you have to pay $4,000.
Sure.
But if it goes any higher, you start to make more money.
Okay.
So if it goes from 330 to 400, you make $70 ish or $70 ish, give or take, on each of those shares. So you'll be up $7,000.
Mhm. Okay.
And the higher it goes, the more money you make. So that Now, that 7,000 you have, you take out five, you put more into your buy and hold. Now you
Yeah.
get to your number faster.
Okay.
And that's that.
All right.
Any other
Cool.
questions?
No, man, it was a definitely a lot of fresh information.
Mm,
Um, a lot of good information for sure.
mm.
Yeah, man, it's a lot, but it was good. It was good.
Was it
Gave me a
worth
lot
it?
of insight.
Was it worth the $50?
Oh, for sure, man. For
Good.
sure. I think it's worth like at least $100, bro. It's 2 hours. I don't know why you got you're undercharging, bro.
Because I need testimonials.
Yeah, man, you're definitely undercharging. That's a $100 course all day long, for sure.
That's good. All right,
Yeah.
man.
All right, brother.
So I'll reach out Friday.
Yes, reach out for sure.
All right,
All right,
cool.
my guy. Later.
Yeah.